inflation. Inflation. A lot of that narrative is cemented in the mainstream media, and talk about the narrative that's in the market. And let's define transitory, because really transitory is just a term. There's no time frames associated with it. And if you step back from what's happening month over month, quarter over quarter, there are significant deflationary forces in the world that we're fighting. So transitory for a period of a year or 2 years probably isn't a problem, right?
If we look at inflation expectations, I think this speaks to a lot of what's going on. So the two lines we have on this chart, these are break-even inflation rates. This is what the bond market thinks inflation is going to be. So when you say 2-year inflation expectations, that's somewhat transitory, 1 to 2 years.
Yeah.
That's something that market participants, a lot of producers, they can look through that, hedge that out, whatever the case may be. 10-year, that's not transitory. So a few things to notice about this chart in terms of what the bond market is expecting of inflation. One, the lines are relatively high. They're both above 2%. They expect over 2% inflation over the next 2 years, 2.72 to be exact, and 2.3% over the next 10 years. So they're high. So even after we get through this transitory hump, which we think there will be a transitory spike and start to fade, you're still going to be running at inflation higher than the past economic cycle. The next thing you'll notice is that the 2-year is higher than the 10-year. This is disinflationary. This also speaks to the transitory nature. This is the collective wisdom of the bond market, which we have more faith in than when we say collective wisdom of the Federal Open Market Committee, but saying that inflation will be higher over the next 2 years than it is over the next 10 years because some of these cyclical factors that are driving up prices will abate as the economy reopens. And the last thing you'll notice is they've stopped going up. They've flatlined and they even started going down. So the idea of runaway inflation is not priced in. And the market has become very comfortable with the idea of a transitory spike in inflation. So a lot of information in this chart and in what the bond market is pricing.
So not terrible news.
No.
Not great news, but
yeah,
sort of as expected, maybe?
Yeah, very comfortable, very in line with the things we have been talking about for the past few months. So the market really getting on board.
When you dump $6 trillion into the economy, you would expect a little bit of this.
A little bit, but yeah, not bad.
So let's look at the components of CPI and show how they're trending.
Yeah, then you have to start to dig under the hood and see, does the bond market have it wrong? Can this transitory thing be a long-term thing? So this is a chart that a little different take on it from what we showed last month that a lot of viewers and clients really liked. So we've broken down the CPI basket into our own groups, and now we've shown them through time. So you have the commodities bucket, so commodities excluding food and energy. These things are included in core CPI. You see those are starting to go up about 6.5% year over year, as expected. The reopening bucket of goods, things like used car prices, car and truck rentals, airline fares, hotels and motels, the things that are tied directly to the reopening of the economy, up significantly. These things appear transitory.
Right.
This is creating the big spike in inflation that we're experiencing right now. Those should fade.
And they're up because of the year-over-year comps, right?
Right. Huge part of it.
Right.
I mean, you literally shut the economy off and now are turning it back on. The year-over-year comparison is going to be tough. That we're comfortable with, the market's comfortable with. The big question now is, let's look at that longer-term bucket. Let's look at particularly, it's called rent of shelter in CPI, which is owner's equivalent rent and rent of your primary residence. Rents are in the CPI basket. And only up, about 2% year over year. And this, to some clients say, well, I hear you guys talk about the housing market. You throw a dart at a map of the United States and you'll land on a town where house prices are up 10% year over year, right? It seems like house prices are up everywhere. So how is this possible? Why isn't that flowing into CPI? And that's something we've done a lot of work on as well, because we think that's sort of the next leg of the inflationary story.
So let's talk about that. And specifically, we have seen prices rise, but the data's on a lag.
Right.
So we could be sitting here today already witnessing the peak in housing prices.
Yes.
So let's walk through this chart and talk about that.
Yeah, great point. So rent of shelter, 40% core CPI, huge chunk. This chart shows the individual rent of shelter components. You have owner's equivalent rent, consumer rent in the blues. And then the green is the Case-Shiller 20-city composite national average for housing prices, up 15% year over year. Huge increase in house prices. And what happens, how these dynamics work is the year-over-year increase in house prices over the next 18 months, about a third of them should bleed through into the CPI. So that's why we're not seeing a huge spike right now.
Right.
It is coming. It's baked in the cake, so to speak. It is coming. But what it's going to effectively do is put a floor under CPI for the next 18 months. This is a huge chunk of the CPI. It's 40%. And it's going to be up about 5%, a third of the house price increase. So it's going to put a nice floor under CPI and should allow CPI to run somewhere around 2%, 2 to 2.5% for at least the next 18 months. So after we get through this transitory spike, you have that to look forward to.
And so translate that into what will happen to people's rents?
So this is very interesting. So what you see is if you're paying rent, so you rent your primary residence, you should see rents start to go up naturally over the next 18 months. The other metric in the CPI called owner's equivalent rents, this is a survey-based measure, and basically you go out and you ask someone who owns their home, what would you rent it to someone for with no utilities and no furnishings? And the answer to that question doesn't change much month to month. Just because your house price went up doesn't mean now you're going to immediately rent it for more. It's more, well, I'm going to cover my mortgage,
right,
or I'm going to cover the carrying costs of the property, whatever the case may be. So that's sort of whatever people say it is. And that's why it has such a lagged effect and it bleeds through over time. So if you are going to rent your primary residence and like you're trying to rent an apartment in New York right now, prices are going up.
So if prices go up 5-10% for rents,
yeah,
how do renters absorb that type of cost increase? That's an enormous burden on somebody. If you're paying it's almost an extra monthly rent payment.
Right. That's why these are the things that the Fed is more tuned into, because they're kind of unavoidable. If you have to rent and you have to pay higher rents, you either need to move or you need to cut spending somewhere else. That's basically it. You kind of have to make it happen.
Or get a higher paying job.
Exactly. So, as long as wage increases compensate for this.
Wage increases would have to be substantial.
Yeah. If they were to compensate for it, then it'd be fine, but that's unlikely.
Right.
Yeah. So
when will we start to see evidence of the impact of this? How long? Are we talking fall or sooner?
No, so already starting to see it in major metropolitan areas that are reopening. You see rents in places like the Bay Area, New York City, they're going up quite a bit right now. And it should continue to bleed through for at least the next 18 months. Yeah.
More to come there.
Yep.
Let's continue our theme of things going up.
Yeah.
Small businesses, prices definitely going up. Prices paid, prices received, all these great things.
Yep. Prices paid, prices received. This is the NFIB Small Business Survey, where they ask small businesses, are you currently raising prices? What percentage of respondents say that? Then are you planning to raise prices? And both of these are basically, this is going to scare some people, the highest number since the 70s.
Yeah.
Coming off of a very low base, right? And it's percentage of respondents saying they're planning on raising prices. A lot of folks are planning on raising prices year over year. Or relative to what's been happening because the economy's reopening. So coming off of a very low base. But this is a chart that gets thrown around that, folks that are trying to draw analogies to what's happening now to, say, the 1970s when we were faced with the oil embargo. This is a scary chart, right? It brings up some bad memories.
Yeah.
What's not in here is the extent of the price increases, just that they're planning on raising them. So it's definitely something to continue to monitor, but once again, it reinforces our narrative that higher inflation for this cycle is basically here to stay. There should be a floor under prices.
Sure.
We should be able to run around 2%, but runaway inflation still seems unlikely.
Yeah. Inflation is definitely trending right now in an upward direction. It might flatten out, but it's going to be here for a bit.
Right, exactly. And so we should have inflation running solidly, slightly above 2% for the foreseeable future. So transitory spike, but then running at a higher level than we saw during prior economic cycles.